Hello, my dear students, and welcome back. Your exams are just around the corner, so today we're going to quickly revise a very important chapter, Debentures. Chalo, let's dive into this. So, just imagine your favorite food delivery app wants to open in, say, 100 new cities. They'll need huge amounts of money for that, right? Crores of rupees. Now, one way is to issue shares, but today we're going to learn about the other big way they raise money, debentures. So, first things first, what is this debenture we're talking about? It might sound like a big, complicated word, but I promise you, it's very simple, beta.
A debenture is basically a certificate that proves the company owes you money, kind of like a formal loan document. You are lending money to the company, and they promise to pay you regular interest, just like a bank pays you on a fixed deposit.
Now, this is a very, very important exam question, so pay close attention. How is a debenture different from a share? Let's make this crystal clear for you. What's really interesting here is the core difference. With shares, you become a small owner, a malik of the company. But with debentures, you are like a banker to the company. You are a lender. That's the main thing. Owners get a dividend only if there are profits, but as a lender, you get fixed interest, even if the company makes no profit. Simple, hai na?
Okay, now for the most important part for your practical problems. The journal entries when a company issues debentures for cash. Let's see how this builds.
First up is the simplest case, issuing at par. This just means the issue price is exactly the same as the face value. No profit, no loss on the issue. A 100 rupee debenture is sold for 100 rupees. Easy peasy. So the crucial point here is, when money comes into the company, what do? We debit the bank account. And then we have to create the liability, right? So we credit the debentures account. See how simple that entry is? Money comes in, liability goes up. Next is premium. Now this is extra paisa for the company. When a company is very reputable, very famous, it can charge more than the face value. This extra amount is a gain for them.
Now look closely here, my dear students. That extra 20,000 rupees? It goes into a special account called Securities Premium Reserve. Since this is a gain, a profit for the company, we credit this account. It's a capital profit.
And finally, we have discount. This is kind of like a sale. The company offers its debentures for less than the face value to attract investors. So, a 100 rupee debenture might be sold for 95. This is, of course, a loss for the company.
And this brilliantly shows how we record a loss. The discount on issue of debentures account is debited. Why? Because all losses and expenses are debited. You have to remember the golden rules of accounting, beta.
Quickly now, let's just touch upon two other small concepts that you should know for your exam. They are quite simple. So sometimes a company might buy a big machine and pay for it with debentures instead of cash. Or it might give debentures to a bank as extra security for a loan. We don't need to go into deep journal entries for these right now, just to remember the concepts.
Okay, everyone, full attention here. This is your cheat sheet for the exam. Let's revise the key points in one go. You might want to take a screenshot of this one.
So the crucial point is to remember what to do with the premium or discount. Premium is a gain, so it's a credit. Discount is a loss, so it's a debit. And here's a pro tip. If the company has to pay back extra money later when they redeem the debentures, you have to record that future loss today.
So here's a little something for you to think about. If you had, say, 10,000 rupees of your own money, would you want the risk and potential high reward of being an owner, or would you prefer the safety and fixed income of being a lender? Think about it.
And that's all for this quick revision explainer. You are all very, very smart, and I know you're going to do wonderfully. Study well, and I'll see you in the next one. Best of luck.